Hi everyone, and welcome to another episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan, and on today's show is just me talking to you today about corporation tax. Now, before you switch off, I think if you're a limited company owner, this one's going to be really important for you, just in terms of whether you're new to it and you're thinking, how does this all work? Or just you want a bit more of a recap. I think for many owners, if they've already got an accountant, they kind of just look at it and just get this tax bill every year, and they don't really understand how it's calculated, how you could reduce it, how is it calculated, when's it calculated, what goes into actually producing it. So in this, I'm going to try and just simplify that for you and just give you a few thoughts on some of the details so you can just get the stuff you need to know without us going in for like a 4-hour session on it, which is going to get you bored very, very quickly. So let's get into it. So then let's talk first, I think, about what corporation tax actually is. So all it is it's the company's tax bill. So you as a sole trader, you're going to have a personal tax bill. You're used to probably, if you've been sole trade before, or you've had a tax return because your income's so high in your job, or you've got a rental property, something like that, you're going to get used to this idea that you have a personal tax return, and then that personal tax return you fill out every year on a free piece of software and it generates a tax bill for you. Now, corporation tax return is a similar concept, just a totally different kind of method of working. And your corporation tax rate is actually relatively easy to understand. If you think about a personal tax, there's all these different kind of rates and reliefs. And is it capital gains? Is it income tax? Is it dividend rate? Is it investment income? Like, what is it? And then there's different classes of national insurance, stuff like that to deal with. With corporation tax, it's just pretty much flat rate. It's somewhere between 19 and 25%. And the way this works is if your profits are under 50,000 a year, we'll talk about what profits are in a minute, you're going to pay 19%, just straight up 19%. Once you go over 19%, you start to pay like a staggered rate. I'm not going to bore you with the complications, but there's this complicated rate that goes on that says, they call it marginal relief, and it gives you some allowance. It means you don't pay at the full 25%, what's known as the headline rate, but you do pay a little bit less. Now, the trick and where it gets costly is when you go over 250k a year, then what happens is you lose it all, and you just pay a fat 25% on all of it. So it's not kind of like you pay 19% to this point and then you pay a bit more, and then you pay once you go over 250, and I'll explain to you why sometimes that 250 limit is actually lower. I'll tell you about that in a bit. Then you just pay it all at 25%. So it gets pretty pricey. So obviously the more successful you are, oddly, the higher rate of corporation tax you're going to pay. Now, the good news with this is that for small businesses, we're not talking about PLCs and big companies here. For small businesses, you're only going to pay once a year. It's calculated and you pay it. Normally, it's based on where your company year end is. So if you imagine your company year end trades all year. So let's say you had 1st of April, just to keep it roughly in line with the tax year. Now, going to say it doesn't have to be in line with the tax year. It is when your company year runs from. But a lot of people sometimes align it. I've done other podcasts talking about whether that's a good idea or not. But let's say for a lot of people, they might have 1st of April, is the start of their accounting year. And then the end of the financial year then is the 31st of March. It goes around for 12 months. You then calculate your profits. We'll talk about how you do that and what you do physically to actually figure that out. And then that line's drawn. All of your profits on paper, what happens then is you get 9 months and 1 day to then pay that corporation tax. Now, there is some variance to that if you start to change your year end, because as I said to you, it's possible. But let's just say in a general scenario, for your average UK small business, is what we're always talking about on this podcast, you're going to pay 9 months and a day later. The only thing, the caveat I would say, is if you're listening to this since your first year, sometimes you've got 2 tax returns, because tax returns for corporates can only ever cover like 12 months or less. Sometimes if your first period might be slightly longer than 12 months because of when you're incorporated, it's a bit technical, but let's just say it's possible, and it's very common that you might see that there's 2 tax returns covering a slightly longer period, and technically the due dates on those tax returns might vary slightly, but it's a first year problem. If you're working with an accountant, you probably won't even notice this is happening, but it's very much there. There's actually an extra return that they do to cover that period. So, and sometimes they can adjust it, but just know that it's there. But you pay it once a year, and that's it. It's fairly straightforward. There's none of this payments on account. There is if you're like a super PLC or something like that, but for your average small business, you're not going to be paying that. You're just going to be paying once a year, which is quite cool. What it does mean is that it's really important in your company to actually store enough money to pay that bill, because the limited company particularly, and this is where a lot of owners get in trouble, is when they don't keep enough for their tax bill, it can cause problems if they're drawing money. So quite frequently what happens is you end up with what's known as an overdrawn director's loan account, because you've carried on taking your wages and really you're funding it off of the tax money that should just be sitting there to pay the bill when it's due. Bit technical, but there are loads of podcasts we've done on that. So if you're interested in that, just go back and find episodes on director's loan accounts, and we talk a lot about those, and I'm sure we'll continue to talk about that for eternity, because it's the most common problem that owners get themselves in, particularly where they've got accountancy relationships where they're just speaking to them once a year. It's very easy for that to occur. So just know that you need to keep enough money in aside for your tax bill. So that's important. And currently, not many softwares provide you with a very good estimate. Oddly, there's one called Free Agent. Now, I'm not a big Free Agent fan. I'm just going to put that out there. If you've listened to me talk about it, you know that I'm a Xero or a QuickBooks fan. But the one cool thing about Free Agent is it at least has a stab at what that corporation tax might be. But if you're working with any kind of forward-thinking accountant, they'll be able to deal with that more frequently for you. I don't think it's actually too difficult a thing for software companies to do. I just wonder why they don't. I presume it's probably to do with liability, because corporation taxes are so many variables. In theory, it's pretty straightforward, and it's going to be 19 or 25%-ish of your profits. So to actually calculate it properly, it's quite difficult. But I think for a piece of software to maybe just provide you with a bit of an estimate, I don't think it's that difficult. But I understand there are complexities, and we do this every day, all day. So to me to say, oh, it's fairly straightforward, arguably it's not, because there are lots of different changes. And I think there'll be accountants screaming at me saying this, going, no, well, that's wrong, Dan, because of X, Y, and Z. And I absolutely agree. If you're technically working this out properly, there are lots of variables to take into account, depending where you are in the year and what capital allowance is available and all these kind of things. But just as a guesstimate, as a thumb estimate for you as the owner to sit and put by, I think if you just looked at your profit and loss account and went, okay, let's just put 25% of that aside, you're going to at least start to generate a good, and when I say 25% aside, I mean 25% of your profit. So you're going to have to actually have a report that shows it to actually figure that out. And when I say profit, I mean like on your profit and loss, so you're going to need a report or something to actually see this. Then you might put about 25% aside and just then at least have something there. That's what I would say, when you move into the limited company world, you actually really need to be more on top of it than you would do maybe as a sole trader. Because as a sole trader, the money's yours. If you haven't got it, then you need to do a deal with the revenue and figure out your time to pay arrangement and all the rest of it. And whilst that is possible with a limited company, you've also got the knock-on effect of how does it affect your personal tax. And there's consequences to having what's known as an overdrawn director's loan account, i.e. taking too much money from the company and robbing its tax bill and being able to enjoy that money. There's a very real tax consequence that can increase that corporation tax. So again, subject to another podcast, but something to bear in mind when we're just talking about the basics. So that said, that doesn't sound too complicated, right? In terms of that's the rates once a year, 9 months in a day. They're the key things to remember with that. But in terms of how it's calculated, this is where people end up with accountants a lot of the time. And the reason being is that unlike your personal tax return, there's no free software to do this. So you need a set of accounts. So with a personal tax return, all you need is you log on to your online gateway that the revenue give you for free, and you just put in fill in the boxes. And some of it, the revenue will even give back to you. But with the corporation tax return, there's none of that. They're very much, well, you're a business, you need to sort it out yourself. There was a free tool, I think it was known as a Cato tool, was the kind of official name for it, where you could do a very, very simple submission of a set of accounts plus a corporation tax return for free. But that's ceasing. At the time we're recording this podcast, it's being discontinued and it will cease to exist. It just won't happen. So you're going to have some way of submitting those accounts, which is normally commercial software, which is why so often that with a limited company, you're going to end up with an accountant or at least some sort of accountancy filing service, because it's not going to be cost effective for you currently to end up going to buy commercial software to submit one set of accounts. It just generally doesn't work. And the other reason is the technical sort of knowledge needed. So the challenge is you could probably fill out and work out a corporation tax return potentially. The difficulty is, can you get the accounts that go with it? So the way it works is you have to do 4 more accounts for a limited company. There's no cash basis. So with a set of like personal tax return, if you were sitting down to do your personal tax return, you can choose something called the cash basis. All you do is add in what went out and what came in, and you're putting those in the box. The skill there is understanding what you can put in the boxes and what's going to get the best tax relief. Is there losses? Can we use them? How do we use it? How do we use other reliefs? Like, there's a lot of skill there, but ultimately on a practical level, it's not difficult. Now, with a set of accounts, you don't have that option. There's no cash basis, so you have to do a full set. And they adhere to these things called the accounting standards. So there's something known as FRS, it's the accounting standard. And you do this big set of accounts, and it can be quite a few pages, this account. So they've got notes on there, and all these things are laid out as standards you have to adhere to. Now, without boring you and covering it too much in depth here, because we have done other podcasts, there are various different types of accounts that you could submit to make that process slightly easier, something known as micros, for example. But again, at the time of recording this podcast, micro accounts are disappearing. So if you're currently doing micros and you're listening to this, note that you won't be able to. That'd be interesting to see how the accounting industry deals with that, because there's a lot of offshored sets of accounts that use micros because it takes a lot less time and they care a lot less, in all honesty. We don't do micros. I've never been a fan of micros. And the reason being is that, and this is part of the reason why it's changing, is like credit referencing agencies and banks. Anyone that wants to see any information on the accounts and get a feel for whether the company's doing okay or not just can't tell anything. There's next to no information on them, really. So, but anyway, that's another side sort of rant that I could go on. But for you, I would say to you, if you're thinking of using micros, don't. There's no point from a long-term perspective. And also the fact that they are going to be ceasing, you might as well get used to it now. So you have to do these sets of accounts, and they're relatively complex to do because you have to take into account the accounting standards of like interest, for example. You might think, well, okay, I know how much interest I got charged. My loan that I took from the business says so, but there's something known as the effective interest method that you have to put in. Depreciation's worked out in a certain way. There's lots of rules basically about how you account for things. Don't even get me started on lease accounting and revenue recognition and things like that. So there's a lot of things to take into account, and that's where accountants train for years to get that bit right. So and it's doing that physical thing. So that gets put together, and then weirdly, how it practically works in the accounting world is you'll do the set of accounts, and then you'll do the corporation tax return at the same time. Now, the reason you do this is that you have to put the tax bill in the accounts. You have to kind of note it to say, look, the company has this tax bill that's due later, but you have to work it out. So you have to do the two together. So you work out what your accounting profit is, then you transfer that into your corporation tax return and do some adjustments, because some things your company might have paid for, it can't have a tax deduction on. So, for example, it's completely fine to take out clients and customers and prospects for food and entertain them as it's known. No problem. As long as it's for a business reason, there are set rules, blah, 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 but in general, it's fine. Then, when it comes to do your corporation tax return, you're not allowed to knock that off your profits that your tax is calculated on. So you effectively have to discount it. It increases your profit, increases the tax bill slightly. And there's a few things that work like that, like depreciation doesn't work. And then you have to do things known as capital allowances. Won't bore you with the detail, but let's just picture it like that. There's loads of adjustments to do. And then it gives you a taxable profit figure to which you apply that 19 to 25%. And then that figure of tax gets then put back into the accounts. So you prepare those two documents together, and then the accounts electronically get tagged as what it's known. There's some special like back-end software thing that tags the values so it can be transmitted digitally to the revenue system. So you've got all that going on. Now, if you thought, yeah, do you know what, that sounds really complicated? It is. And that bit is complicated, and that's why accountants exist. Without that, I wouldn't have a business. So, we'll have a business, but that's a large part of it, as you can imagine, is doing these limited accounts. So they go in, and the reason I mentioned they have to do these together is you might look, if you Google it, there's actually two different deadlines in play. Normally, on a normal year end, your company accounts have to be submitted with Companies House. So there's two places they need to go. One is, we're talking about the revenue side right now, the HM Revenue and Customs Tax Office side, but you also have to submit a set to Companies House. Now, I said about micros, so the reason people like micros for public record, so Companies House is public, the revenue's private. The reason they like the micros for the public one is because there is next to no information. But as I said, that can actually cause problems with lending and things, and people wanting to give you credit scores and stuff off of them. But you've got those, but you always do a cut down set of accounts anyway for Companies House. You don't want your competitors knowing how much money you turned over or how much profit you made or didn't make. Particularly if you're a startup, I think it can be embarrassing for the owner to be like, okay, well, I only did X this year, and the data is sometimes so historic that the first year might look really bad and the next year is really good, but you haven't got around to the filing deadline yet. So now, at the time of recording this podcast, if you've listened to this for any time with me talking about this, you'll know there's some big changes coming up actually for Companies House soon, which are going to require you currently, I don't think this is going to change, I don't think there's enough political pressure, is that you would have to put your turnover and profits on Companies House. But it's still going to be a cut down set of that. We're still awaiting the actual format of it. So the reason I mention this either way is right now, you don't have to do that. So you would do a cut down set of accounts. But even when that comes in, you're still going to do a cut down set of accounts because you still want to put absolutely minimal data. You don't want people seeing how much you spent on marketing, for example. There's no need to tell the world what that is. So when you do this, or when an accountant does it for you, you do this full set of revenue detailed accounts that go to the revenue with the corporation tax return, and then you do a cut down set without the tax return that just goes on the public record at Companies House. Now, the Companies House filing deadline is about 9 months after the year end normally. So in a normal year, it's going to be 9 months after the year end. And the tax due date on the left-hand side, if you think of Companies House on the right and the revenue on the left-hand side, the tax is due normally 9 months and 1 day from the year end. So you can see doing them together times well with tax payment and when they've got to be in. But weirdly, and it's worth noting, the corporation tax return doesn't actually have to be submitted until 12 months after the year end. It gives you a bit of extra time, but you're nearly always going to do it for the filing reason. There are sometimes you might use that extra time of filing deadline to do, particularly if you've got, maybe losses or there's some other quirks going on. there's a few technical scenarios where we would use that, but it's very rare. If you think about it, most of the time you're going to aim for this 9-month sort of deadline window, and that just gives you a feel for it. And as I said, at the moment, there is no free software for any of this, or the free software that's currently available to do the very limited filing is going away. So there we go. But you definitely do want to do 2 sets of accounts. Now then, I do want to talk about a couple of traps and some thoughts on how you would reduce that corporation tax bill, because I think that's in our game, that's always of interest and, one of the primary reasons that we're in business. So we'll talk a few very top level tips on that. But in terms of traps, there's a couple of traps here. One, do you remember I said to you at the beginning that you pay 25% if you go over 250k profit? Now that's true in an area where you've got one company. Where people get in trouble is a lot of entrepreneurs are kind of like this. I don't want to use ADHD because that's just how sometimes owners refer to it, because obviously that's a diagnosed condition, but they're saying, I've got like ADHD brain and I've got these ideas and I need to go and boot up a new company for this. And people come to us. I mean, I've seen people come with 7 or 8 companies. Now, from our point of view, that's fantastic. We will absolutely help you file 7 or 8 companies. Brilliant. Do you actually need them? Undoubtedly no. Nearly always there's no point to have that many companies, but sometimes there is. Like I've got genuinely some really successful people that have 10 plus companies, but they all do slightly different things, or maybe they're in property and they want to ring fence risk. There's lots of reasons why you might want multiple companies. But the big tax trap when we're talking about corporation tax is that 250k limit effectively gets split for every other company that you've got. Now it's more detailed than that. There are a lot of conditions. It comes down to what's known as control. So they look at, do you control it? So, and there are instances where you might be in business with someone else and that company doesn't count towards what we're talking about here. But let's just say you own them all 100% and you've got like 5 companies. That 250 is going to get split. And it's very easy then to just wipe out that 19% rate. So, and weirdly, you can have a company that in doing this, a couple of them are losing money, and then the only one that actually is making any money is technically paying tax at a higher rate. Now, there's things you can do with losses depending on the situation, but just know the takeaway for this is you can end up costing yourself money just by having random companies that are sitting there not doing a lot. If they do absolutely nothing, so they're what's known as a passive holding company or something like that, passive company, they don't actually count. But that is so rare to see. So people say, well, I got a holding company because I booted it up. I saw this great piece of TikTok tax advice telling me that a holding company structure is going to save me loads of money. And I put it in place, and then you're like, cool, what's it doing? Well, it's just doing a bit of this and a bit of that, and it's got some money in the bank and getting a bit of interest. That's not passive. So it's going to cut your limit in half on the trading company. So these kind of things they don't talk about very often on the internet. They'll tell you all the cool things of why holding companies are good. And again, plenty of clients with holding companies, they're really good in the right circumstances, but they're not some miracle solution to saving loads of tax. So I spend quite a lot of time, as do my team, talking to people about, and we should probably do a podcast on that, talking about why it's actually a bad idea to do it, or really myth debunking a lot of time, because people are like, I've seen this thing on, it's normally TikTok, but I've seen this thing on social media, and they'll say that I can charge management charges and I can do this thing, and then we have to explain, well, that's fine, you could, but here's all the consequences of doing it. It doesn't actually save you any money in your circumstance. Actually, it's going to cost you money. So if that's you and you're like, oh wow, just get some advice on it. But know that, the more companies that you own and you're adding into that mix, there's potential there to cost yourself corporation tax. So that's one tax trap. The other really easy tax trap to avoid is that when you go to pay your corporation tax bill, you've actually got to use a reference. They give you this reference, but so many people get the reference wrong or don't pay it, or they use last year's reference because it's saved on their banking app. And the revenue system's not very clever. So if you've got like you submit a tax return and it says that the tax debt's £15,434 exactly and some pence, and you make that payment with pence currently, but you use the wrong reference, it will sit there as if you've paid last year's period, and it'll sit there and you'll get letters and interest telling you haven't paid the bill. And then, don't get me wrong, they'll fix it when you contact them, but do you need another conversation with the revenue and trying to get through there and get them to reallocate this payment and wipe your interest off? You're just taking man hours out. So the takeaway is make sure you use the right reference. So that's the other bigger trap that I would say that pops up quite frequently and is really, really easy to avoid. Now, in terms of how to reduce it, that is probably an entire podcast on itself, but I just want to give you 3 quick thoughts for this. One is, and again, if you've listened to me for any time, you'll know this, keep good records. The most tax is saved by making sure you capture all of your expenses. Is always the time. I get so many people that come to us, they've either got a revenue investigation and the revenue is saying the OX tax, but the revenue aren't taking into account any of the expenses because the records aren't easily identifiable, and then we have to come in and help them put these records together, or they've done tax returns and they're too scared to claim even though they have expenses. There's all these things that go on. So just keep good records is going to be the easiest way to get that sorted, and making sure you do something like using some sort of software to capture them. Obviously, as I said, I'm a Xero fan, so if you go to Heelan Associates, heelanhassociates.co.uk/0. There's a ridiculous offer there that will get you a good discount on a license if you're thinking of entering that world. So go and have a look at that. But yeah, getting good records is going to be the biggest one. Now, a couple of other things on this. I think knowledge would be one. Luckily for you, you're here listening to me ramble on about corporation tax, so you're already in that. But just learn what's possible, learn how things work. And just because even the best accountant in the world, particularly if you've only got an annual thing where you're seeing them once or they're just available for support, that's a great service. But at the same point, they can't be in your head. You're not having enough conversations to really understand where there's opportunities. So you knowing what's possible can really help. Obviously, the accountant will tell you, if you say, can I deduct this? They're going to tell you, but it's really hard because it's so broad and everybody's business is so different. There are some key common stuff, but you might have some really cool, like harebrained idea you thought of what you want to go and do, but you don't know if it's tax deductible or not. And knowing that is going to make a big difference, because you can also get yourself in trouble by then doing it. Like the amount of times I see somebody, they'll it doesn't happen with us, but because we've got great relationships with our clients, but they come to us as a prospect where they've had like a filing only service that's offshored or something like that, and they'll say, oh yeah, I've got this BMW whatever massive petrol car costing them a fortune in tax, which actually if they'd known and had a good accountant at the time or knew how company car tax worked, they might have made a different decision. So just think about knowledge, but you're here, so you're already on that journey. And then I'd say timing is a big one. So we already said that your year end, your line is drawn at the year end for the corporation tax. If you imagine there are decisions you can make coming up to that year end, like if you're about to refresh your computer and your IT equipment in say a month's time or 2 months time, if you do it now, it's actually going to accelerate the tax relief. So your next tax bill's going to be impacted. You're still going to save tax if you sold it, if you bought it a couple of months later, but it's going to affect the tax bill that's miles away. So it's like in that example where your year ends the 31st of March, oddly, the worst time to buy something would be the 1st of April, because you could have bought it a week ago and got your tax relief off your next bill. So timing is really, really important, as is things like your own pay, timing of dividends, lots of things. Timing is massive in tax. So just think about if you're coming towards your year end and you need to refresh some things, it's worth thinking about whether refreshing them would actually impact your tax bill and whether it's a good idea. Same with things like paying into pensions and the like. They're really important with the timing. So that's kind of three main ones. And of course, biases aside, the fourth one would be get professional help and get decent professional help. Again, if you look, there are lots of different accountants in the world. Some will just do a great filing service for you. Some will do more. You've just got to be thinking about what do you want, what are you willing to invest to get that kind of information. So, but getting professional help is obviously going to help. That's it. Hopefully that's given you a bit of an idea then of what corporation tax is, or a bit of a recap on what it is if you already know, and when you pay it, and the practical process towards calculating it, because I think a lot of people don't really understand that. So hopefully you have found value in today's show, and if you have, please do share it with anybody that needs to know this information. As I said before on previous ones, we've started lobbing these up on YouTube. Sometimes there's a delay from when you're listening to them to the next show just because of workflow on that, but we are putting them up there. So if you do want to interact and comment in the comments, it's a nice way to do that. I think with our main YouTube channel at Heelan Associates, we interact all the time with people asking questions and things like that. With a podcast, it's difficult. I talk literally to a brick wall or a microphone and a camera, and that's it. We can see the listener numbers, which is great, but we don't really have conversations. So YouTube allows us to do that. So if you do want to ask anything, go in there and have a look. If you do want to talk about the podcast in general, you can email direct info@heelanhassociates.co.uk, and we can talk to you about how we might be able to support you there. But sometimes the comment bit, if it's just a quick question or something, it can get you a nice easy answer. So if you have enjoyed the show though, make sure to subscribe via your favourite app so you don't miss an episode. It really helps our visibility. If you get 2 seconds, if you could just review the podcast as well, that would be really cool. And for more business insight and tax tips, be sure to connect with me and my great team on all the social media channels, including of course LinkedIn, YouTube, Instagram, TikTok, Facebook, Twitter, or if there's a social media channel, we're likely on it. You can sign up to our 2-weekly HeelanHub Herald, which is a newsletter packed full of business insight and tax tips and resources. And you can do that by going to our website, heelanhassociates.co.uk. Scroll around long enough and you'll get a pop-up that pops up there so that you can sign up. And we never sell your data. It's just to talk to you. And that's a really good way of, increasing your knowledge. If you do want to get in touch about the podcast, as I say, you can do so. Email direct info@heelanhassociates.co.uk. That's it. Have a profitable tax efficient couple of weeks, and I'll see you on the next one.